And let's talk some mixed sectors. I got Tom White here with me in studio, and joining us, Michelle Connell from Portia Capital Management, back with us for a look at JNJ, who's rallying right now about 3%, but we're also going to look forward a little bit to some of the other earnings coming. Michelle, thanks for being here. Let's talk some healthcare. JNJ finally going to kind of get back on track here?
Thanks again for having me, Oliver. Maybe in the short term, I still think they have some clouds in front of them. Of course, it's great to see that they beat earnings, but they did take down guidance for the year by about 72 cents. And they still, the clouds I was alluding to are the talc settlement. They're still not out of the woods there. And they've got generic coming on board for their largest product, which services Crohn's disease and colitis, and that happens in the EU mid this year and in the United States next year. So I think investors need to look forward a little bit and incorporate some of those issues.
Okay. As we look to the future here for the value trade, is J&J one of them? Would you describe it as a value stock?
I would say maybe it's a little bit of a value trap versus a value investment. We're still looking at slow growth. I mean, Johnson & Johnson holds a plethora of companies. And so even with the fact that they're bringing on a lot of companies through M&A, and by the way, that's one of the reasons why they took down their earnings estimate for the year, is incorporating 3 more companies that they bought. Their internal growth has slowed below 5%, and they're probably going to have to continue buying their way out with acquisitions for growth.
That's so rough because they're already buying their way out of legal problems.
True. And there may not be enough money for that, and they'll be paying on those settlements for about 25 years, Oliver.
Yeah, wow. Good points. Hang with us. We're going to look forward, maybe some different earnings in a sec. Tom, let's trade J&J, though. Looking at options here, I think to Michelle's point, there's still a lot of proving the stock has to do.
Yeah, and I think the way that I looked at it, using the option market, is the dividend, the yield that it creates.
They got that going for them.
Yeah, because the stock's still down slightly on the year, about 1.5%. So looked at a cover call strategy. For every 100 shares of stock that you buy, you want to own the shares to collect that 3.2% dividend yield. You sell an upside call against it. I looked at in the August 160 strike call, paying roughly, I've got 153 half debit on it. It's probably a little bit higher than that. The stock keeps moving up here. But basically what this type of strategy allows you to do is own the shares, collect that dividend yield, and then also create yield on selling that upside call that's out of the money by about $5 to the upside. And as you get closer to expiration over the next 30 days, you can buy that short August 160 strike call back, roll it to another weekly or monthly cycle. That creates credits, increases potential profitability, but it's almost like a wait and see type of strategy, Oliver, where you're just in it for the yield, but you want to own the shares because of the dividend.
Okay. All right. So I think that's a reasonable approach. You've got very limited expectations for the performance of the stock with this trade.
For sure. That's, your upside is capped. It's definitely a neutral to bullish type strategy. But with the rolls and the adjustments that you can do on the short call, that allows for more profitability on that trade.
Got it. All right. Nice. Okay. Makes sense. Let's look forward here. Michelle, let's talk United coming out this afternoon. I mean, as we just discussed, it's like they're pricing some of these airlines to disappear in the case of Spirit. American got dinged again with the downgrade today. Is there anything that United can tell us to keep that separation of the distance between it and its peers?
It's interesting because United, and I'm sure your option strategist is going to speak to this, it's been up 6% in the last few days, and call options, the volume has been double of what they are on average. So I think the market, up until today anyway, because you saw what happened with Spirit, was expecting them to buck the trend, so to speak, because we saw what happened with Delta last week. But maybe it's going to be harder for United to pull that off, given what their peers are doing at the same time. You have the issue of they're looking at a potential strike with their flight attendants. That's going to be voted on this August. and you have the issue with, flights in the international, especially to Paris. People are not flying to Paris or the EU. They're trying to avoid the Olympics, and that was Delta's issue. And I think we're going to see some maybe short-term softness, and maybe there's a way to trade around that.
Right. Seems like the travel is not the problem, right? It's the financials of the businesses. So then maybe we'll find out management navigated it smoothly.
Maybe we will, but I don't know that they're going to be able to give us a confirmation on the potential wages being increased for their attendants. And by the way, attendants are asking for at least 10% of an increase.
Yeah, wow, true. Michelle, great stuff. Good facts. Good knowledge on the stocks. Appreciate that. All right, Tom, give me United Trade real quick.
Yeah, shares are up 13% this year, down 4% so far this month into earnings, plus or minus 7% move expected in the shares, about $3.50. So I looked at a strategy where I can help pay for a bullish call calendar that takes advantage of that implied volatility dispersion. It's a customized trade where I'm going to sell a put vertical in the July 19th weekly cycle, sell the 45-43 put vertical. That collects a credit, right? And then I'm going to buy the July 26th weekly 50 strike call and then sell the July 19th 50 strike call. So creating a 1 week wide call calendar to the upside. So you can see here, it's 4 legs on this spread. If you collect a credit of about 35 cents, it takes your break even all the way down to 44.65 over the next 9 days. It's about 5% below the current share price. But what you're doing on this, you're collecting a credit. So anything above that break even of 44.65 is going to be profitability. But you're using that short put vertical, the 45.43 put vertical in the near term that expires in 2 days to help finance the purchase of that call calendar to the upside. So apex of profitability you can see here from the risk profile at or near that 50 strike. So if you think this stock's going to go up post earnings on a good report, this is the way to take advantage of that one standard deviation move to the upside.
That's a fun little roller coaster ride of a P&L chart you got there.
Yeah.
All right.
It is.
But bullish.
Yeah, when you lose money is below that 43 strike, or that break even max loss is below 43.
Yeah, so betting against a big sell-off.
Right.
A giant one. All right. Thanks, Tom. Thanks to Michelle Connell from Porsche Capital Management.